Hi, this is Mark Allen, CEO of Allen Capital Group. I'm here with Travis Portwood, Chief Investment Officer of Allen Capital Group. In today's video, we're going to present to you our 2020 market outlook. As we look forward to 2020, it's helpful to look backwards in 2019 and see what happened during that year. So Travis, why don't you tell us a little bit about what you saw in 2018 and what got us to where we are today?
So 2019 was an unprecedented year in terms of returns for the stock market, right? The S&P 500 was up over 30%. The U.S. aggregate bond market was up over 8%. And you normally don't see those two indexes move in lockstep. It was kind of a year when rising tides rose all ships. What drove that? You had a couple major themes really driving the market in 2019. First, you had a Fed pivot in the beginning of 2019. And what I mean by that is the Fed spent 2018 raising interest rates. Beginning of 2019, slowing economic growth, a little bit of market turmoil there. The Fed changed course, they paused, and then started cutting rates in the middle of the year. Anytime you cut interest rates, that's a buoy for financial assets. Lower interest rates now mean higher present values, right? The second theme that was driving market optimism in 2019 was towards the end of the year, we got a skinny trade deal or a partial trade deal. And I think the market believed that we sidestepped a worst case scenario there. We still don't have a completed trade deal, but it was enough to drive investor optimism and move markets higher.
So one of the key things we look at in terms of making our decisions from asset allocation and investment decisions is valuations. So where do we sit now with valuations?
Well, valuations, if you, in a historical context, are high. You know, if we're using the S&P 500 as our benchmark, we started the year. The valuation metric we like to look at is the forward PE ratio. So that's the price of the stock over the earnings that the stock creates, right? And that gives us a gauge of where things might be valued. So we started the year, now remember this is after the fourth quarter, we started the year at about 14.5 PE ratio on the S&P 500. And throughout the year it expanded to 18, right? So that tells us that investors today are willing to pay more for future earnings of a corporation than they were at the beginning of the year. Now that's interesting because we didn't get any earnings growth from S&P 500 companies during the year. Normally you have to have earnings growing to support higher valuations. So the way I look at that is the expansion of the PE ratio or the expansion of valuations was market sentiment driving returns. It wasn't backed up by earnings growth. So looking forward, we have to determine, will we have earnings growth in the future?
And just because valuations are high doesn't necessarily mean that the prices of stocks would have to fall to get back to long-term averages of valuations. We could have the E increase and prices stay the same. So high valuations don't necessarily dictate a correction of prices. Correct?
Correct. It makes it a little, it could make it a little more likely, but you're correct. So that's what we hope, is the earnings actually come up and match the price.
The bull market we're in is longer than historical bull markets, but the bull market doesn't know how old it is.
It does not know how old it is. This is the longest expansion in bull market in history. Not the biggest by magnitude, but the longest in time. So yes, this could persist for some time. We don't know.
And age does not kill a bull market.
Age does not kill a bull market.
So tell us where we are in regards to GDP growth and what factors we're looking at that might impact GDP growth in 2020.
Right, so GDP growth is important. We talked about company earnings growing. Well, the economy has to grow to support company earnings growing, right? With the last reading we got on economic growth or GDP growth, the consumer was the primary driver, almost 100% of all economic growth. The consumer feels good right now. We've got a low unemployment rate. We've got some wage growth, and that's driving them to spend. Where we're lagging is investment spending or company spending. Because of the uncertain economic environment caused by slowing growth around the globe and trade negotiations, you've created an environment where companies aren't willing to invest as much into the future, or invest as much into future growth because of the uncertain environment. They don't know what's going to happen. So that is going to be a drag on future growth. And then the question will be how long can the consumer shoulder this load?
The final core data point is debt. And with interest rates being historically low, the consumer, the government, corporations have all had an easy time taking on debt. How is this going to impact things going forward?
So, right, the consumer's in better shape than I would say the corporations are right now. The corporations have taken the low interest rate environment and used it as an opportunity to lever up their balance sheet by taking on the cheap debt. We're in a situation now where we've got 50% of investment grade debt is rated BBB. And for those that don't know, BBB is one rating above junk or high yield bonds. So the fear now is if we do get into an uncertain environment or deteriorating economic environment, these companies might not be able to service this debt. And if that happens, you could have a significant portion of this BBB debt move down into high yield or junk bond status, and that wouldn't be good for holders of that debt or for holders of the bonds invested in that. See?
So in this environment where we're at right now, you see the probability of interest rates being lower for longer.
I think interest rates are going to be lower for longer, correct. We don't have any indication that they would go up. You might see some steepening in the yield curve, as markets get more comfortable with what's going on. The longer dated maturities or the longer dated interest rates are what the shorter ones are going to be in the future, technically. That's what the market's saying about that. So we'll see where things go from here. We don't think about investing in 1 year increments. We think about investing over the long term. And the most important thing you can do is have a plan in place and remain disciplined while executing that plan.
Yep. So we talk about being disciplined, staying in your lane, making sure that you don't react at the wrong time for the wrong reasons. And in the end, that's how you're going to win.
Correct.
We hope you enjoyed our 2020 market outlook. If you have any questions or comments, don't hesitate to reach out to any one of us at Allen Capital Group. Thank you again for watching and enjoy the rest of 2020.